Take a look at the buying conditions for durable goods. It's down 12%. All of that job growth, like all of it, was concentrated in one area. This decline, it's not limited to just one specific group. It's across the board. Democrats, Republicans, independents, all ages, different income levels. What's even more concerning is that we've now had 2 months in a row with these unusually large increases.
So where do we go from here then? All right, welcome back everybody for another deep dive. Well, today we're diving headfirst into the ADP Employment Change Report. This one just came out for January. The headline number is kind of shocking. 183,000 jobs added just in January.
Oh yeah.
I mean, that was way more than most economists predicted. They were thinking something like 155,000.
Yeah, something like that.
So I mean, that's got to be a good sign, right?
Yeah, I mean, on the surface, when you just look at that top line number, it's like, wow, things are going pretty well. But, as always, the devil is in the details.
Yeah.
We really got to dig deeper. We got to see where those jobs are. You know what I mean? What kinds of jobs are we talking about here?
What are the details telling us?
All of that job growth, like all of it, was concentrated in one area.
Really?
Yeah, it was all in the service sector.
The service sector.
Yep, 190,000 new service jobs.
Wow, 190,000. That's a whole city's worth of jobs. So that's got to be good news for folks in that sector, right? Like, I mean, that's a lot of opportunity opening up.
Yeah, absolutely. I mean, if you're looking for a job in the service industry, things are looking pretty good right now.
But if all the growth is in services.
That's the other side of this report, right?
Yeah.
That's the less rosy picture, maybe.
Yeah.
Goods producing jobs, those actually decreased. It was only by about 6,000.
Okay.
It's a small dip, but it kind of makes you wonder if there's something else going on there, right? Like, is there something bigger at play that we need to be thinking about?
Okay, so we've got this booming service sector, but then on the other hand, we've got this slight decline in these, goods producing jobs.
Well, it's definitely a mixed bag, On the one hand, you've got this overall job growth, which is great news. I mean, it means the economy is still expanding, it's creating opportunities. But if you're someone whose skills are more in manufacturing, construction, things like that, you might find yourself facing a bit more competition than you used to.
If you or someone you care about is thinking about job stability, this is something to keep in mind. The economy is always changing, and understanding where job growth is happening can help you make smarter career and financial decisions. Of course, every location and individual situation is unique, but in general terms, jobs in the service sector tend to be more resilient. Why? Because services, like healthcare, education, and technology, are often in demand regardless of economic cycles. Meanwhile, goods-producing jobs, like manufacturing and construction, are more vulnerable to shifts in costs, supply chains, and economic slowdowns.
Is it automation? Are companies able to, produce the same amount of goods with fewer workers?
Yeah. I never thought about it like that, but yeah, that's a really good point. So what does this all mean for the future then? I mean, should we be worried about this decline in goods producing jobs? Like, is that a bad sign?
I don't think it's necessarily a cause for alarm,
Okay.
at least not yet. But it's definitely something we need to keep an eye on. We need to understand what's really driving this trend.
Now, let's move on to the Employment Situation Report.
Oh, okay. Jobs report.
Sure.
Kind of looks good at first glance.
Right.
Strong job growth.
Yeah, good numbers.
Wages are going up,
Yeah.
but could that be a problem?
Well, let's start with that wage increase.
Okay.
So we saw a solid 0.5% increase in average hourly earnings,
Okay.
which on the one hand is great news for workers, right?
Yeah, more money in their pockets, right?
Exactly. More money to spend.
Exactly.
Here's where things get a little
Okay.
bit tricky.
Yeah.
A significant wage jump like this can actually fuel something called sticky inflation.
Ooh, sticky inflation.
Sticky inflation.
Okay, what is that?
So, think about it this way. Prices at the grocery store, they're going up.
Yeah.
But even if other economic factors suggest that maybe they should start to come down,
Okay.
they stay high. They're sticky.
Okay.
That's sticky inflation.
So it's like good for people, when they first get the wage increase.
Right. But then those prices stay high.
Yeah.
And it kind of eats away at those gains.
Yeah. So it's like a double-edged sword.
Yeah, exactly.
So how does that impact like the bigger picture?
Well, it puts the Fed in a tough spot.
Okay.
Remember, they're trying to control inflation.
Right.
And a hot job market, like the one we're seeing,
Uh-huh.
it can actually make that harder.
Okay, interesting.
Yeah.
So we talked about the wage increase.
Right.
What else did we see in this report?
Well, there were some pretty significant upward revisions to the
Uh-huh.
previous month's job numbers.
Oh, really?
Yeah, so November and December's numbers got bumped up
Okay.
significantly,
Oh.
adding an extra 100,000 jobs to the total. We're talking December going from 256,000 to 307,000 jobs added,
Wow, okay.
and November jumped from 212,000 to 261,000.
Wow, those are big jumps.
Yeah.
What does that tell us then?
Well, it suggests that the job market is even stronger
Okay.
than we initially thought.
Okay.
The 3-month average for total non-farm payroll increases
Uh-huh.
went from 204,000 to a whopping 237,000. It's a robust job market.
But as you said earlier, that could make things tough for the Fed.
Exactly, because they want to see a strong job market,
Yeah,
but they also want to control inflation.
Yeah.
And those two things sometimes are,
they're at odds.
yeah, they can be at odds.
So what's the takeaway here?
Well, it's a bit of both, right? On
Yeah.
the one hand,
Huh?
the strength of the job market is undeniable,
Yeah.
but we can't ignore the potential downsides of that strength.
Yeah. So where do we go from here then?
Well, I think the big question is, how will the Fed respond to this data?
We'll now analyze the survey of consumers from the University of Michigan, also known as the University of Michigan Consumer Sentiment Index.
Right, so we're going to break down this February 2025 University of Michigan survey of consumers. See what it all means for you and your world.
Yeah, it's always interesting to see how this kind of survey, really gives us a glimpse into how Main Street is thinking and feeling. And as you know, that can have a pretty big impact on Wall Street.
For sure. So the big headline here is consumer sentiment. It's down for the second month in a row. Actually, it hit its lowest point since July 2024.
And what's really interesting is that this decline, it's not limited to just one specific group. It's across the board. Democrats, Republicans, independents, all ages, different income levels. So for someone like you who's watching those broad market trends, that's definitely something to pay attention to.
Yeah, it definitely seems like there's this widespread unease,
Yeah.
which makes sense, right? You think that would have some kind of impact on the market.
Yeah.
But it's not just the overall mood that's down. It's literally every single component of the sentiment index.
Yeah, I mean, take a look at the buying conditions for durable goods. It's down 12%. That's a pretty big red flag.
Wow, yeah.
These are those big purchases, right? Like cars, appliances, the kind of things people usually put off buying if they're not so sure about what the future holds.
And the report even specifically calls out tariffs as something that's really weighing on people's minds. They even use the phrase, quote, too late to avoid the negative impact.
Hmm.
I mean, do you think maybe traders are picking up on that same kind of vibe?
Oh, absolutely.
Hmm.
I think it's definitely possible. If consumers are starting to factor in the long-term effects of these trade tensions, that hesitation could easily spill over into how the market behaves.
Okay, that makes sense. And then on top of all that, you've got inflation worries, which are way up. Year-ahead inflation expectations jumped from 3.3% to 4.3%. That's a pretty steep climb in just a month.
Yeah, and it's the highest it's been since November 2023. What's even more concerning is that we've now had 2 months in a row with these unusually large increases. In fact, we've only seen a 1-month jump that big 5 times in the past 14 years. It's a pretty rare occurrence.
High inflation eating away at their wallets, all this talk about tariffs impacting the economy. Wow, no wonder consumers are getting nervous. It's a lot to process. Does this kind of line up with what you're seeing from a market perspective?
Absolutely. You have to remember, consumer behavior is one of the key drivers of the economy. If people are holding back on spending because they're worried about inflation, that translates to slower growth, which ultimately impacts those company earnings and then stock prices.
Okay, so how do you, as an expert, connect all these dots for someone like our listener who's actively trading in this environment? We've got declining sentiment across the board, specific concerns about tariffs, and this really sharp spike in inflation anxieties. What's the big takeaway here?
Well, I think first and foremost, it really highlights how important risk assessment is in a market that could be pretty volatile. Consumer confidence is shaky, and as we've been talking about, that can have a real domino effect.
Right. Yeah, that makes total sense. But, this report also mentioned something about consumers being divided on the economic impact of President Trump's policies. Like, some people expect his policies will actually help curb inflation, while others think it's going to make things worse.
Yeah, that's a really important point. All this uncertainty surrounding policy outcomes, it just adds another layer of complexity for investors. It's almost like they're trying to navigate this market where the rules of the game are constantly changing.
And they did mention that interviews for this report wrapped up on February 4th. So it's a pretty up-to-the-minute snapshot of how consumers are feeling, right?
Exactly. It's capturing the current mood more than trying to predict what's going to happen in the future. And what this snapshot tells us is that consumers are feeling more and more anxious about those rising prices, which, as we know, could very well lead to a pullback in spending.
And, consumer spending drives so much of our economic growth.
Yeah.
So a slowdown there, yeah, that could have some pretty serious knock-on effects in the market.
Absolutely. I think along with those inflation expectations, I'd be paying really close attention to that drop in buying conditions for durable goods. It's a sign that people aren't feeling so confident about the economy's long-term prospects.
And remember, they specifically called out tariffs as a potential reason for that hesitation. So that trade policy uncertainty, yeah, that's definitely something to keep an eye on.
For sure, for sure. And another data point that I think is worth watching is the decline in expectations for personal finances. This suggests that consumers are feeling less secure about their own economic situation, which again could lead to even less spending.
So we've got this declining sentiment overall, those rising inflation fears, the policy uncertainty, and now weakening consumer confidence. It sounds like there's a perfect storm brewing.
Yeah.
What does all of this mean for someone who's actively out there trading stocks?
Well, it definitely creates a more challenging environment. There's no doubt about that. But, as any seasoned trader knows, volatility can also create opportunities. The key is to stay agile, closely monitor all these different indicators, and be ready to adjust your strategy as the landscape changes.
So as we wrap up here, what's the one big takeaway you'd want to leave our listener with as they head back into the trading world?
I'd say pay really close attention to how consumers react to these economic headwinds. The survey of consumers, it's almost like a sneak peek into how they're feeling.
Hmm.
And you can get a real sense of the, potential market trends and shifts just by watching this data.
Almost like a leading indicator, right? Like if
Right.
consumers start pulling back, the market's probably going to follow.
Exactly. And for someone like you who's actively trading in the market, well, that kind of insight is incredibly valuable.
While the CPI report for January was meant to be the main course, the, shall we call him curator of this Boursa trading library, made the call to wrap up the video here. Why? Because to truly understand what's happening in the market, we first needed to go through the latest employment reports and consumer sentiment data. And let's be real, he's a full-time trader with the freedom to trade just a few hours a day, not a YouTube content creator working against deadlines. Besides, packing everything into one video would make it way too long. So that's it for now. It's time for some fresh air and a well-deserved doggo walk. But stay alert. Or better yet, subscribe. Because our next video will fully break down the CPI report. You won't want to miss it.
So to wrap things up for our trader out there, any parting words of wisdom
Yeah.
as they head back into that trading world?
Stay informed, stay agile, and remember, even when things feel uncertain, there are always opportunities for those who are prepared.
Great advice.